I was around the gold market in 2000 when the increase was much more muted. It went from 250 to 1900. Am I saying that gold is going to go to $9,000? No. Am I saying it's not going to go to $9,000? No. It's going to trade inversely to confidence in savings products denominated in the world's reserve currency. It's my own personal belief that the deterioration in the purchasing power of the US dollar for American citizens is much higher than that which is suggested by the CPI, which I don't believe is a cost of living index. So I don't think that the US dollar is doing objectively well in isolation. I think it's doing well compared to other fiat basket cases.
Gold prices have soared to record highs in recent months, defying analysts' expectations as demand for the precious metal surges globally. Just a year ago, spot gold was valued at $2,000 per ounce, but it has since climbed to $2,294 per ounce, marking a remarkable 14% increase, reaching a peak of $2,431.52 per ounce in mid-April. RickRule, founder of Rule Media, emphasizes gold's role as a hedge against currency devaluation and economic uncertainty. Despite the US dollar's long-standing status as the world's reserve currency, Rule suggests that gold is a form of insurance and liquidity, particularly during economic instability. He cites historical examples of gold price increases during periods of uncertainty, highlighting its ability to preserve purchasing power over time. The unprecedented surge in gold prices reflects heightened global uncertainty, driven by factors such as trade tensions, geopolitical conflicts among major powers, record-high interest rates in advanced economies, and ongoing conflicts, particularly in the Middle East. Furthermore, the US dollar, once dominant in global markets, is now facing challenges and weakening in its position. The emergence of multipolar currencies and calls for de-dollarization have contributed to the dollar's diminished global stature. Pressure from inflation has also led to a gradual depreciation of the currency. According to an article by Pragmatic Capitalism, the greenback has lost nearly 96.4% of its purchasing power since 1913. Rule expresses concern about the US dollar's purchasing power and believes that gold can protect against wealth erosion caused by inflation. He reiterates historical examples of gold's ability to preserve purchasing power, emphasizing its enduring value in uncertain economic climates. Join us as we delve into RickRule's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
I've never really understood the importance of the gold to silver ratio other than as an easy rule of thumb. The prices are set not merely by relative supply, but rather by relative utility. It's important to note, too, that most silver isn't produced from silver mines. It's produced as a byproduct of mining other stuff like zinc and lead and copper. So I think it's important for the questioner to understand that there are a whole bunch of factors with regards to the disparity in price between gold and silver, other than merely their relative abundance in the Earth's crust. Gold has been doing well in currencies other than the US dollar for quite some time, as you know. What I like to quote when people ask me that question is a flight to quality. Now, I say that advisedly. I joke that the US dollar is the worst currency in the world, with the sole exception of every other currency. And I think what you're seeing is disintermediation from a whole range of currencies around the world, from the yen as a consequence of Japan Inc.'s balance sheet, to the ruble as a consequence of the fact that the Russians are spending more money than they're taking in, to the renminbi, to the euro. The US dollar is doing well only relative to other currencies. It's my own personal belief that the deterioration in the purchasing power of the US dollar for American citizens is much higher than that which is suggested by the CPI, which I don't believe is a cost of living index. So I don't think that the US dollar is doing objectively well in isolation. I think it's doing well compared to other fiat basket cases. People who listen to your show get really excited about a move in gold from 2,200 to 2,470 or something like that,
Yeah.
some up candle or something like that.
Sure.
That's not why I own gold. I own gold because I'm afraid it's going to go to some number like 8,000 or 9,000. I was around the gold market, never mind in the 70s when it went from $350 to $850. I was around the gold market in 2000 when the increase was much more muted. It went from 250 to 1900. Am I saying that gold is going to go to $9,000? No. Am I saying it's not going to go to $9,000? No. It's going to trade inversely to confidence in savings products denominated in the world's reserve currency, which is to say the US dollar. And while I'm more comfortable about the U.S. economy than I am most other economies in the world, I am not confident about the maintaining my purchasing power in U.S. dollars, particularly at today's low interest rates. I consider gold to be insurance. I consider it to be cash too, non-correlated to cash. I consider it to be liquidity. But I actually own gold now because it helps me sleep nights and stay calm.
The U.S. commercial real estate market, valued at roughly $20 trillion, is encountering a significant liquidity crunch, exacerbated by high interest rates and an impending wave of maturing debt. RickRule highlights potential challenges for the market, which could impact the balance sheets of banks, both small and large, affecting their competitiveness and stability. According to analysts from the University of Southern California, Northwestern University, Columbia University, and Stanford University, U.S. banks hold approximately $2.7 trillion in commercial real estate debt as of the end of the third quarter. Recent interest rate hikes have contributed to the failures of Silicon Valley Bank and Signature Bank, and the distressed sale of First Republic Bank earlier this year. Clients withdrawing deposits and banks burdened with illiquid, low-yielding loans have exacerbated these issues. Despite the potential for bank failures, Rule reassures that most depositors, particularly those with deposits under $250,000, are covered by FDIC insurance. However, political factors may influence depositor protection, as demonstrated by the bailout of politically connected depositors during the Silicon Valley Bank bankruptcy. Let's get back to the interview.
I think that's right. I think that the sins that existed in the banking system, sins that were built up over the prior decade, haven't been completely dealt with. You know, David, at its root, banking is a pretty simple and a very good business. It's basically blocking and tackling, paying attention to the fundamentals, sticking within your circle of competence, coming to work every day and being sane. The business got so easy during a period of declining interest rates and a low cost of capital that bankers quit the sanity part of banking. They engaged in what is called a time spread, which is to say they took on deposit liabilities that were very short term, overnight often, with variable interest rates, and they took on assets that were long term at fixed rates. When the interest rate rose, their cost of capital rose, while their return on capital employed fell, in some cases to negative levels. If you do that with a 6% or 7% equity slice, if you are dumb enough to take on a time spread, past as prologue. This took down an industry in the United States some years ago called the savings and loan business. It was a fairly big business. And any banker today that didn't learn the lessons inherent in the 1990s with the savings and loan business deserves to go broke. Absolutely are going to see more bank failures. The FDIC has to manage this crisis, both because of its own resources and because they don't want to see a crisis in confidence. But the truth is that the Fed brought this this problem on itself in the sense that there are in-place rules that allow banks that have long-term loans on the books where they say that they are, quote, going to hold them to maturity, that they're going to hold these assets to securities. In other words, what the banking regulators are allowing the banks to do is to perpetrate fraud. And the banks are only too happy to oblige. So, yes, we are absolutely going to see more bank failures unless there is a fairly precipitous decline in the interest rate. I don't think that the Federal Reserve wants to lower the interest rate because the Federal Reserve is still concerned about inflation. So they're in effect stuck between a rock and a hard place. If interest rates stay high, the funding costs for the banks stay high, while the portfolio values of loans they made during periods of low interest rates fall, which is to say their liabilities overwhelm their assets. It's a very difficult conundrum for the Fed. I do believe in some markets that the other shoe is yet to fall. with regards to commercial real estate and that's impact on some banks' balance sheet. My suspicion is that the carnage there won't be restricted to banks with a sub $10 billion market capitalization. It may be that the mega banks are too big to bail out. But the truth is that I think that some of the big banks will, for a time, become less competitive too, as a consequence of strains on their own balance sheet. I think that this will be felt throughout the banking system. By the way, much to the benefit of sanity-based banks. From a depositor's point of view, most people will be taken care of. It's worthy to note, by the way, in the bankruptcy of Silicon Valley Bank, that the politicians decided that even the jumbo depositors, the politically connected, the important depositors of Silicon Valley Bank should be covered. So while federal deposit insurance only covers deposits up to $250,000, when it's bad politics to allow depositors to be punished for being non-judicious or stupid, the government bails out those depositors too.
Gold's surge reflects its role as a hedge amid economic uncertainty, while the U.S. commercial real estate market faces liquidity challenges. Although most depositors are protected by FDIC insurance, political factors could sway depositor protection. How do you see these dynamics shaping the economy? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.